Are we going to see more bank failures,
We
or is Republic
we
First the
a-
last? This
absolutely are going to see more bank failures. The FDIC has to manage this crisis, both because of its own resources and because they don't want to see a crisis in confidence. But the truth is that the Fed brought this problem on itself. What the banking regulators are allowing the banks to do is to perpetrate fraud.
bank failure and financial crisis fears have once again spiked following the failure and seizure of Republic First Bank last week. What's going to happen to our savings, the financial sector, and even our wealth? Let's find out with our next guest today, Rick Rule. He is the co-founder of Battle Bank, the former CEO of Sprott US, and the president of Rule Investment Media. Rick is a fan favorite of the show. He is a legendary investor and speculator, and he has many thoughts about not just the banking sector, but also our economy, the commodities super cycle that we're perhaps seeing, and the Federal Reserve. We'll talk about all these topics today. This episode is sponsored by Notion, link down below. And if you're new to this channel, make sure to subscribe down below. Hit that bell button for daily updates with finance and economics experts. Rick, always good to see you. Welcome back.
David, thank you for that kind and flattering introduction. I appreciate it.
Well, I'm just being objective. So let's talk about a lot of things today. Commodities, prices going forward, your outlook. We spoke last time in Vancouver 3 months ago. Prices have run up significantly since. We're going to do a recap. We're going to talk Fed and we're going to talk banking. Let's start with banking first. As you know, another bank failed last week. Republic First was seized by regulators. And this is not over, according to some pundits and experts out there. And in fact, Christopher Wolf, managing director and head of North American banks at Fitch Ratings, told CNBC that you could see some banks either fail or at least, dip below their minimum capital requirements. The report goes on to say that hundreds of small and regional banks across the U.S. are feeling stressed. This seems like a deja vu from last year. Rick, what is happening right now?
Well, I think that's right. I think that the sins that existed in the banking system, sins that were built up over the prior decade, haven't been completely dealt with. You know, David, at its root, banking is a pretty simple and a very good business. It's basically blocking and tackling, paying attention to the fundamentals, sticking within your circle of competence, coming to work every day and being sane. The business got so easy during a period of declining interest rates and a low cost of capital, where you could refinance out of your mistakes, that bankers quit the sanity part of banking. They engaged in what is called a time spread, which is to say they took on deposit liabilities that were very short term, overnight often, with variable interest rates, and they took on assets that were long term at fixed rates. When the interest rate rose, their cost of capital rose, while their return on capital employed fell, in some cases to negative levels. If you do that with a 6% or 7% equity slice, if you are dumb enough to take on a time spread, you deserve to go broke. Remember, David, past his prologue, this took down an industry in the United States some years ago called the savings and loan business. It was a fairly big business. And any banker today that didn't learn the lessons inherent in the 1990s with the savings and loan business deserves to go broke.
Are we going to, I'll just ask you point blank before we talk more about the intricacies of banking. Are we going to see more bank failures,
We,
or is Republic
we
First the last? This
absolutely are going to see more bank failures. The FDIC has to manage this crisis, both because of its own resources and because they don't want to see a crisis in confidence. But the truth is that the Fed brought this problem on itself in the sense that there are in place rules that allow banks that have long term loans on the books where they say that they are, quote, going to hold them to maturity. They don't need to mark them to market. All they have to do is make an election, whether true or false, that they're going to hold these assets to securities. In other words, what the banking regulators are allowing the banks to do is to perpetrate fraud. And the banks are only too happy to oblige. So, yes, we are absolutely going to see more bank failures unless there is a fairly precipitous decline in the interest rate, which would skate those banks back onside. I don't think that the Federal Reserve wants to lower the interest rate because the Federal Reserve is still concerned about inflation. So they're in effect stuck between a rock and a hard place. If interest rates stay high, the funding costs for the banks stay high, while the portfolio values of loans they made during periods of low interest rates fall, which is to say their liabilities overwhelm their assets. It's a very difficult conundrum for the Fed.
Before we continue with the interview, I want to tell you about our sponsor today, Notion. With the rise of artificial intelligence comes the rise of the fear of losing our jobs to AI. And this is a well-founded fear. There's plenty of research done to support the fact that we could lose our jobs to AI. IBM, for example, has put out a report saying that people who use AI will replace people who don't. The report forecasts that 4 in 10 workers could face disruptions due to AI by the year 2028. Goldman Sachs also estimates that 300 million full-time jobs could be impacted by a new wave of AI systems. Don't be one of those people who lose out. Don't be replaced by AI. Instead, use AI to boost your productivity, making you irreplaceable. Notion is here to help you with just that. Notion is a workflow software which harnesses the power of AI to make you more efficient, allowing you to complete time-consuming projects within seconds, so you have more time to manage your investments or watch your favorite YouTube programs. Notion AI, well, with a single click, fix your spelling and grammar mistakes, shorten paragraphs, explain technical jargon, and even generate high quality translations. Notion never uses your data without your explicit consent, thus protecting your privacy. Now, let's suppose that you have investments in an investment company and you want a summary of your financial statements. Run the financial statement through Notion's AI and look at the results. No longer do you have to pour through pages and pages upon financial data in order to determine how you'd value a company. And if you're stuck, just use Notion AI's new Q&A feature, which functions like your own personal assistant. Q&A goes beyond traditional AI chatbots by understanding your business, including previous decisions and meeting notes, to provide accurate and relevant answers. For example, Notion can summarize a market analysis report. It can also find historical performance of assets like stocks, gold, and crypto. The Notion Q&A feature is included in all existing Notion AI subscriptions. So get started today with Notion AI for only $10 per month. And if you don't have Notion AI yet, then join today and you'll be able to be added to the waitlist to get early access to Q&A. If you're ready to unlock the power of AI for your business, job, or personal use, just click on the link below or scan the QR code here. Don't be replaced by AI. Learn to use it. Start using Notion today. Okay, so we are going to talk about the Fed just a minute. Yes, they kept rates unchanged this week on Wednesday. But going back to banking first, can you walk us through the mechanics of why these banks or how these banks are failing? From what I understand, Rick, and please correct me if I'm wrong, but many of these losses are still unrealized losses, meaning they haven't completely written off these assets yet. Why do they need to collapse?
I think reality is one
Okay.
problem. Despite the fact that the banks don't need to write off the losses, the banks do need to publish the amount by which their loan books are underwater. And so you have independent rating agencies, including Fitch, that will show you that the aggregate pro forma loan losses on some banks' books exceeds their equity. In other words, it's apparent to the market that these banks are zombies. The other thing that happens is that to the extent that your cost of capital exceeds your return on capital employed, you don't have the money to make new loans, which is to say, your failure, or at least you're being tripled, becomes a self-fulfilling prophecy. And we're seeing that across American banking. What we're seeing really among banking investors, community bank investors in particular, and also sophisticated depositors and sophisticated borrowers, is a return to quality. You're seeing very high quality community banks, things like Farmers and Merchants Bank of Long Beach, First National Bank of Alaska, banks that have always balanced their assets and liabilities, have always maintained good equity slices, and have never engaged in these crazy time spreads, do very well. You are seeing other banks that were too aggressive paying the penalty for being too aggressive.
So going back to this article here, consulting firm Claris Group analyzed about 4,000 U.S. banks and found 282 banks faced the dual threat of commercial real estate loans and potential losses tied to higher interest rates. We just talked about higher interest rates.
Right.
The majority of those banks were smaller lenders with less than $10 billion in assets. So, Rick, first of all, these rates have been high for quite some time. And last year, we saw bank failures happen in quite a number of jurisdictions. Why haven't capitalization requirements improved or their banking capital improved over the last year?
That's a question that you should direct to the banking regulators.
Okay.
I suspect that the politicians view any act which even temporarily scares voters or constrains the flow of capital is a bad thing. My cynical belief is that probably some of these small bank shareholders, officers, and directors are important local campaign contributors, and that might have something to do with the willingness of people in Congress to force the banking regulators to make the banks much more forthcoming. I'd like to address the second thing you said, which is something that I didn't mention, but that is the difficulties that seem to be emerging around commercial real estate, in particular the office market. I was not too long ago in Manhattan, and I know that anecdote is not the same as statistic, but I was in a sort of a B grade office building midtown, and that office building was 12% occupied.
Mm.
There is no way that that building meets its operating
This
expenses.
is
Never
recently, Rick?
mind,
Recently?
yeah, three
Okay.
months ago.
Okay.
Never mind services its debt. And I do believe that in some markets, and I'm not an expert on commercial real estate, but I do believe in some markets that the other shoe is yet to fall with regards to commercial real estate and that's impact on some banks' balance sheet. My suspicion is that the carnage there won't be restricted to banks with a sub $10 billion market capitalization. It may be that the mega banks are too big to bail out. But the truth is that I think that some of the big banks will, for a time, become less competitive too, as a consequence of strains on their own balance sheet. I think that this will be felt throughout the banking system. By the way, much to the benefit of sanity-based banks.
Okay, we are going to talk about battle bank in just a bit. But okay, how will this ultimately affect the consumers? For most people who have less than $250,000 deposits, they're covered by the FDIC. So is it fair to say that even a bank failure or a series of bank failures wouldn't directly have an impact on most people?
I think that's absolutely correct. From a depositor's point of view, most people will be taken care of. It's worthy to note, by the way, in the bankruptcy of Silicon Valley Bank, that the politicians decided that even the jumbo depositors, the politically connected, the important depositors of Silicon Valley Bank should be covered. So while federal deposit insurance only covers deposits up to $250,000, when it's bad politics to allow depositors to be punished for being non-judicious or stupid, the government bails out those depositors too.
Okay, that's exactly my next point. We can expect bailouts, backstops from the government. So again, ultimate impact on the market, one could argue minimal, given that we are going to just get backstopped, right? Or
Well,
no?
I think what you have to concern yourself with is confidence. Economies in the near term and currencies rely on confidence. To the extent that we have a new rash of bank failures and confidence in banking, in the economy, in equity markets, in the American political system begins to get challenged, then what I think you see is the typical political response, which would be to say quantitative easing and fiscal measures to what really should be a regulatory issue.
Leads me to my next point. What constitutes a sound bank per your definition, and why do you think the bank that you're running right now fits that definition?
I think that banks should be adequately capitalized, first of all.
Yeah.
The the powers that be suggest that an equity slice of 7% is adequate to run a lending portfolio. At age 71, I much prefer 10 to 7. I think having a larger equity slice is better business. I think, too, the banking business has been its own worst enemy in the sense that the banking industry continues to contrive new deposit products whose principal aim seems to be to trick customers as opposed to service those customers. In the banks that I've been involved with, we generally have one deposit product, a high yield money market account that you can write checks against and still get paid money for your money on deposits. We, and by extension, the whole banking industry doesn't need 15 deposit products. You need one money market deposit, and you need a range of CD deposits that suit the customer's need. The purpose of any business is to suit its customer, and the banks seem to have forgotten that. On the lending side, I like banks that lend only to industries that they understand. Some of these financial supermarkets attempt to lend in 1,000 industries. How can they possibly understand 1,000 industries? In banks that I have been associated with and banks that I've been an investor in, banks that have been successful, they have known 3 or 4 or 5 things extremely well. They have competed very vigorously in the markets that they understand, and they haven't gone into markets that they don't understand. Those banks are thriving today.
Well, I have to address some viewer questions. I polled my audience on X right before you appeared on the program today, right before we logged on, and I asked people, "What would you ask Rick Rule?" Some interesting questions came in. This is from James. At Tourbillon38, a superb guest. For me, anything he thinks is worth listening to multiple times. Would be interested to know how long he thinks his current commodity upcycle should last in years.
Well, I wouldn't be surprised to see the commodity upcycle taper off a little bit in the near term. I think we've enjoyed too much. I think it's too far too fast. So, depending on the gentleman's time frame and the amount of leverage he's employing in his portfolio, I would suggest that the current upcycle may only have weeks. My belief, however, is that we are in the early stages of a fairly dramatic commodity supercycle. The only thing that would cause me to walk that back would be a broad-based economic recession. The truth is, David, that there are more than 8 billion of us on the planet. Humans being what humans, humans doing what humans do, we add to that number every day. And those people around the world want to live like you and I. The commodities boom has everything to do with a fairly recent, which is to say 40-year trend in human history, where we've done a reasonably good job of increasing the living standards of the poorest of the poor. When poor people get more money, and we've done a great job over the last 40 years, making poor people less poor, the things that they want are physical. When you get more money, David, you buy a service or you buy some little gizmo from Apple that doesn't
Sure.
have any commodities in it. But when poor people get more money, they increase the calorie count in their family. Their method of locomotion goes from barefoot to sneakers to a bicycle to a 50cc motorcycle to a Toyota Hilux. They want stuff that's made of stuff. I would argue with you that most of the resource renaissance in the period 2000 to 2010 could be traced back to Deng Xiaoping saying to be rich is glorious, to urbanizing 450 million Chinese. And I think we're seeing that process occur around the world. Meanwhile, that increased demand is running into an industry that is underinvested in sustaining capital for 30 years. And I think the collision between the impact of underinvestment and an expanding market will be higher and probably sharply higher commodity prices. We can talk about precious metals later. I hold them in a separate category. I'm talking now about, conventional energy, oil and gas, copper, agricultural minerals, things like that.
Which commodities, if any, Rick, do you think will not be able to adequately keep up with the pace of population growth?
Well, copper comes immediately to mind. I mean, we have a lot of copper, and we will find a lot of copper, but we haven't invested for it. We haven't searched for it for 30 years. We haven't found much because we haven't looked very hard. And when we do find it, we often have extraordinary barriers to production. The first being social rents, taxes, regulation, royalties. The second being regulation. As an example, there's an amazing copper deposit called the Resolution Deposit in Arizona in the United States, in a wonderful location around a bunch of copper mines, roads, rail, power, workers trained at copper mining. That deposit is 1.5 billion tons of 1.5% copper, 3 times the average mine grade worldwide. And that deposit has been stuck in permitting for over 25 years. um, I understand that people have to have a say in resource development, but people are going to need to juxtapose this say with the price of all things made from things on a global basis.
Speaking of energy and producing things, this is a question about uranium and energy. Came in from Eric Anderson. How long before the U.S. realizes nuclear is the way to go, especially building SMR, small module reactors, and how will that affect the spot uranium ETF?
I think that the small modular reactor will make an important difference around the world, but I don't think it will for 10 years. We're working on that technology. Yes, it's efficacious. Yes, it works in the U.S. Navy. It powers submarines around the world. But the commercial application around SMRs, which I think will be gigantic, David, in 10 years, won't be felt for 10 years. In the near term, the first thing that moved the uranium market was, of course, as you and I talked about a year ago, the pace of Japanese restarts. That's done. The second thing is that the cure for low prices was low prices. When we had low prices, we knocked off a bunch of supply while demand stayed steady. The impact of SMRs, the impact of the broader utilization of uranium through economies around the world, led, of course, by China and India, but including Korea, Taiwan, United Arab Emirates. Uh, a higher uranium price, maybe not a higher uranium price from here, but a higher uranium price from the time that you and I first talked about it, was absolutely positively in the cards. I think, by the way, what's important for uranium speculators to understand now are not extraneous factors like the U.S. political grandstanding around Russian uranium, or even the spot price. I think the important thing to know about the uranium business is that the structure of the market has gone from a spot or overnight market to a term market, which means for the first time in my memory, in any commodity that I follow, both producers and consumers will be able to lock in with some certainty price and volume. That will make the uranium industry much more creditworthy and give it a much lower cost of capital. That's the important thing to focus on in the uranium trade.
Okay. On to gold now. Several questions for you about gold. You mentioned that gold is not, in your opinion, part of the other commodities we talked about. It's its own category. 2024 end of year gold prediction came in from David at 11D Browns.
I didn't understand the question. I'm sorry.
What is the 2024 end of year gold prediction from Rick Rule?
I'm way too old and smart to answer that question. I have no idea. I can tell you about the direction in commodities, and I can tell you about where.
Okay.
There are so many variables around an exact price that I have no idea. What I can tell you is this. I'm an old guy, fat, rich. I feel better owning gold than not owning gold, despite the fact that I could reasonably self-insure against any economic circumstance. And things that allow me to sleep nights and stay calm are things that are of high interest to me. And I think that if more people thought like I did, there would be less angst and more happiness in the world.
All right. Well, here's a more here's a more fundamental question. I think. What does he think about when and if gold to silver ratio could come to Earth's normal ratio of 16-1 from current 86-1? Um, any idea?
I've never really understood the importance of the gold to silver ratio other than as an easy rule of thumb. The prices are set not merely by relative supply, but rather by relative utility. It's important to note, too, that most silver isn't produced from silver mines. It's produced as a byproduct of mining other stuff like zinc and lead and copper. So I think it's important for the questioner to understand that there are a whole bunch of factors with regards to the disparity in price between gold and silver, other than merely their relative abundance in the Earth's crust.
Well, I have a few questions of gold of my own, Rick. Why is it that gold and the dollar has been moving in tandem over the last month and a half? Historically, they've moved in opposite directions, but they've both been going up together.
Well, gold has been doing well in currencies other than the US dollar for quite some time, as you know. What I like to quote when people ask me that question is a flight to quality. Now, I say that advisedly. I joke that the US dollar is the worst currency in the world, with the sole exception of every other currency. And I think what you're seeing is disintermediation from a whole range of currencies around the world, from the yen as a consequence of Japan Inc.'s balance sheet, to the ruble as a consequence of the fact that the Russians are spending more money than they're taking in, to the renminbi, to the euro. The US dollar is doing well only relative to other currencies. It's my own personal belief that the deterioration in the purchasing power of the US dollar for American citizens is much higher than that which is suggested by the CPI, which I don't believe is a cost of living index. So I don't think that the US dollar is doing um, objectively well in isolation. I think it's doing well compared to other fiat basket cases.
Okay. Perfect segue to the next question from Nick. I love to know Rick's opinion on the direction of the U.S. dollar as well as CAD.
I think if you're asking me the question, the US dollar relative to the Canadian dollar, I think the US dollar continues strong. American politics is insane until one views it in the Canadian lens. The idea that your budget will balance itself or that there's no business case for the export of Canadian energy around the world when all of your trading partners want it makes politics in my own country look sane. And politics in my country are not sane. So while the American dollar will be challenging for Americans, the American dollar will look like a safe haven for Canadians.
Well, I think this partly answers this question. I'd love to know his thoughts on Canada's new budget and just the state of Canada in general. Well, just to add to that, Rick, because you know, capital gains tax proposals have been coming in. Trudeau's government has proposed to increase the capital gains tax to 66% in the states. It's been proposed to rise to 44.6%. With certain limitations, right? What are your thoughts on this? Will it have any consequential impact on investments, capital flight, so on and so forth?
It absolutely will. It's the politics of envy, which are very popular. When people are concerned about your prime minister and they're concerned about his longevity, they need to remember that what I consider to be the consolidated left, the Liberals, the NDP, the Greens, the Bloc Québécois, regularly commands 60% of the popular vote in Canada. And my suspicion is that for the consolidated left, the politics of envy are a reliable vote getter. The idea that they could eat the rich, I think, is extremely attractive. You will note that 1% of Canadian taxpayers pay about 40% of capital gains and income taxes in Canada. If you were going to make the rich in Canada pay their fair share, you would have to give them a very large rebate. And I don't think that anybody is proposing tax fairness in that regard.
Let me ask this a different way. Would this proposal change the way you view gold as an investment, as a preservation of wealth? Suppose you were to buy gold and, you and several individuals would qualify for a 66% capital gains tax rate if you lived or domiciled in Canada, but you're buying gold to protect your wealth against inflation or the debasement of your currency, but half of that is going to get taxed. So what's the point?
Well, I guess you'd have to compare gold with other asset classes. Your only real alternative to paying capital gains tax would be a certificate of deposit in a Canadian bank in a currency that's declining, where the deposit interest that you're paid is less than the deterioration of the purchasing power of the currency you're getting paid back in. In other words, I don't see what choice you have. I think in the circumstance, gold would be part of any prudent Canadian's investment portfolio simply because this budget and this government uh, will absolutely positively reduce the purchasing power of Canadians,
Of all Canadians, we're just the
of,
wealthy ones who
of
qualify for this.
all Canadians. Think about what artificially low interest rates do. Artificially low interest rates penalize small savers, penalize people who are trying to prepare for their future by systematic savings, by reducing the amount of income they receive on their savings. At the same time, those very low interest rates actually subsidize somebody like me with access to credit. I get to borrow money for a lower cost than I otherwise would without government interference. So, one example of the Canadian budget and the US budget for that matter is the ongoing subsidization of borrowers by depositors. This, by its nature, is prejudicial to middle class and working class people. But the more important thing, I think, David, is the damage that this does over time. What you do when you run a very large deficit is that you eat your seed corn. You consume the value that you had hoped to bequeath on young people and on the unborn. In effect, the social service expenditure that you see in Canada and that you see in the United States can be observed in the contrast between you and I. I'm an old guy. I voted myself all kinds of cool services. You know, Canada Pension Plan, Social Security in my country, Medicare, Medicaid, but I forgot to pay for them. So I get to enjoy all this stuff, and you got to pay for all of it. And this budget, the liberal budget, and in my country, the Democratic budget, are attempting to increase the level at which younger people subsidize older people in a very dramatic way.
This trend is only going to exacerbate, I believe, Rick, because if you look at the long-term fertility rate trend, it's getting lower, which means women are having fewer babies on average than 40 years ago. And we are expecting the dependency ratio of developed countries to go up, meaning there will be more non-working people over the age of 65 and under 14 to every working person. That could mean higher social security costs for the government. So in essence, we're going to get a wider deficit in the future if we don't tax people more, unless there's another solution.
Oh, there's a very obvious solution. You're too Canadian to mention it. You have to reduce expenditure.
But we have to pay for social security and welfare and whatnot. That's the
Well,
argument, right?
I think the argument is that the existing social welfare programs are much too generous. We transfer way too much money to old folks like me, much more than they ever put in. And I think that we need to address that. Whether or not the voters in your country or mine will stand for that. You know, voters often object to arithmetic. It's very, very inconvenient. Narrative is much more fun. But the truth is that we have been spending substantially more than we have been investing for a very long time. And eventually, as Margaret Thatcher said, you run out of other people's money. We're approaching that. Now, for a while, if you can command their faith, their confidence, but not their money, you can cheat them by printing. You don't steal their money via taxation. What you do is you counterfeit a whole bunch of specious currency units and you add liquidity to the system for a while. It worked in Zimbabwe for 3 years. Why not Canada for 3 years? You know what I'm saying? But over time, what you do when you print these additional currency units with nothing to back them up is you devalue the existing currency units. And it's the devaluation of the existing currency, whether it be the Canadian dollar or the US dollar, that is the bedrock for the reason that people need to own physical gold. It's the only medium of exchange that doesn't have a built-in voting constituency in favor of depreciating it.
Would you extend the same phrase for digital assets?
I don't know enough about digital assets to comment.
Okay.
I know that gold has stood the test of time.
Sure.
Uh, in digital assets, I certainly understand the benefit of anonymity. And I understand, too, the network effect, which is to say, one Bitcoin isn't worth anything. 16 million Bitcoin trading, that's probably worth something. The same way that one telephone was worth nothing. But a billion telephones makes that one telephone have some value. So I certainly understand the network effect. I understand the anonymity, although one wonders how anonymous they are. But the truth is that I don't understand personally digital assets well enough to see them for myself uh, replacing gold in any substantial portion in my own portfolio.
Well, you do understand the Federal Reserve monetary policy, so let's close off on this. The Fed kept rates unchanged on Wednesday, May the 1st, to nobody's surprise. But what they were addressing really is stickier than expected inflation. What is your view on inflation? That ultimately that will affect decisions from the Fed going forward.
Well, I need to say I'm in contact with some lower level people in the Fed, given the fact that I'm trying to start a bank.
Yeah,
And the lower level people in the Fed, first of all, I have to say, not just to flatter them, but they're very high quality people.
sure.
And the Fed as an institution believes itself to be the only institution in the United States that stands between the US dollar and oblivion. They see absolutely no restraint in Congress. And I think the bias of the Fed employees is to keep the interest rate high to fight inflation. I wish the interest rate was untethered to the Fed, which would, of course, make it go higher. The subject of inflation, David, though, is one that I hope your audience will listen to us well on. We seem to conflate inflation with the CPI, and the CPI is an artificially constructed index. As we said in our last interview, among other things, the index doesn't include, when it's inconvenient, fruit or fuel. I like to eat and I like to drive. So an index that doesn't include food or fuel is a sort of a silly index to me. But much more importantly, as a cost of living index, it doesn't include tax. The largest household expense for most working Canadians and Americans is tax. And something that's conflated with a cost of living index that doesn't include tax isn't even fiction. It's fraud. I do a thought exercise myself where I try to measure the price of the goods, the basket of goods and services that I consume, including tax. Not that I really feel serviced, but anyway. And it's my belief that the purchasing power of the US dollars that I earn and I save is declining by about 7% compounded. The CPI tells you that the US dollar is losing ground at about 2.7% a year. My suspicion is that the actual deterioration in the purchasing power of the US dollar is 400 to 450 basis points higher than that. The conundrum comes when you look at the value that you get from your savings. If you invest the money in a US 10-year treasury at 4.3%, and you receive back a currency where the purchasing power is declining at 7% compounded, you can understand that you lose 2.8% of your purchasing power every year. If you do that for 10 years, it begins to hurt in the out years.
Well, have the lower level people in the Fed given you any indications of what they are telegraphing next? This is something I've heard. The Fed at some point may become frustrated with Congress for spending too much money, or at least not reining in their spending, which in itself may drive inflation, according to some economists. And so the Fed may either keep rates higher for longer, or in the most extreme case, even hike once more.
This goes back to the beginning of our conversation, ironically, around banking. If you see a rank of bank failures, and if you see declining confidence in U.S. capital markets and the U.S. dollar, I think that you'll see the Fed forced to cave politically and lower interest rates. If the economy continues, at least statistically, to be in relatively good shape, I say statistically because there's a big variance in the United States. There are a lot of people doing very well, those people who have marketable skills, and there are a lot of people doing very poorly. So while our economy is performing extraordinarily well statistically, it isn't performing for all Americans. And to the extent that that dichotomy, among other things, causes a deterioration in the confidence around the U.S. political system and the U.S. economy, I think that you'll see the Fed forced to lower interest rates. And if you see them forced to lower interest rates, like they were in 1975, I'm old enough to remember that, I think you'll see real fireworks in the gold price.
Okay, real fireworks. Again, I'm not asking you for the forecast goal for the end of the year, but what are we talking about for real fireworks? What does that mean for you?
Well, here, I'll give you a headline.
Okay.
The people who listen to your show get really excited about a move in gold from 2,200 to 2,470 or something like that,
Yeah, yeah,
some up candle or something like that.
sure.
That's not why I own gold. I own gold because I'm afraid it's going to go to some number like 8,000 or 9,000. I was around the gold market, never mind in the 70s when it went from $350 to $850. I was around the gold market in 2000 when the increase was much more muted. It went from 250 to 1900. Am I saying that gold is going to go to $9,000? No. Am I saying it's not going to go to $9,000? No. It's going to trade inversely to confidence in savings products denominated in the world's reserve currency, which is to say the US dollar. And while I'm more comfortable about the U.S. economy than I am most other economies in the world, I am not confident about them maintaining my purchasing power in U.S. dollars, particularly at today's low interest rates.
Put it this way, you must have seen something in gold in the 70s, 40 to 50 years ago, that did very well for your investments. If you were 50 years younger today, would you still speculate in gold today?
I don't speculate in gold personally. I speculate in gold stocks.
Okay.
I regard gold as insurance. And
Okay.
despite the fact that I'm old and fat and rich, I said it, not you.
That's incorrect. I've seen you in person. You're not fat. But anyway.
You need to change optometrists. But at any rate, I consider gold to be insurance. I consider it to be cash too, non-correlated to cash. I consider it to be liquidity. But I
Okay.
actually own gold now because it helps me sleep nights and stay calm. And at age
Okay.
71, a good night's sleep is a real luxury.
I have two more questions from the audience. We'll close off here. These are questions that amuse me personally. Number one, how do I make an easy million?
I've never made an easy million in my life, David. I've worked very hard. I've made many millions, which means I've worked very hard. My suggestion is, and I'm not going to answer the question because I don't think there's an answer. Uh, I think the answer is to develop skills. Money is made in the long term, and money is made by delivering value to others. If you deliver value to others, they will give you their money because they value what you deliver more than they value the money. The excess of what you produce over what you consume, the surplus, is called savings. So spend less than you earn. Begin by investing the balance prudently. And when you can afford to, if you have the right mindset for it, and if you're willing to work hard, speculate.
So came in from speaking of skills, IBM put out a report. They forecast 4 in 10 workers could face disruptions from AI by the year 2028. So what skills are we talking about that could make us AI resistant?
I think that you need to employ the AI.
Okay.
I'm really, truly looking forward to using AI myself to do many things. As an example, I could take an interview like this with AI, and I could have AI listen to the interview and timestamp it.
Yes.
That
Yes.
would be of enormous benefit to me. A whole bunch of the securities analysis that I do could be done by artificial intelligence. It would be up to me to ask AI what to look for, and it would be up to me to interpret the results. But I think knowing your subject well enough that you know how to employ AI to generate utility for your customers is going to be a wonderful thing. Are most people willing to think that much? Are most people willing to work that hard? I don't know the answer to that. I am. I'm looking forward to it.
Final question, Rick. This has been a great talk. Why don't guys like you ever slow down and live the rest of your years in peace?
Well, first of all, I'm fascinated by what I do. I joke that I do it for free if it didn't pay so well. That may or may not be true. When my wife asked me that question, I told her, Bonnie, you know, my mind is active. It needs to be stimulated or it needs to be sedated. And working is better for me than drinking. The consequence of that is that I still work very hard.
Okay. Well, do you feel at peace even though you're working very hard,
Oh,
Rick?
I'm having so much fun, David. I mean, I need to say, at age 71, I don't have the energy that I had when I was 30. But the truth is, I get up every day wanting to go to work, wanting to learn, wanting to teach, wanting to build things, wanting to mentor people, wanting to invest in young people. Life is absolutely grand, despite the challenges that I so often talk about on shows like yours.
Well, we appreciate your services to the community, the investment community. Where can we follow you, learn more from you?
I would love it if your people came to ruralinvestmentmedia.com. If they like what I have to say about natural resources, list your natural resource portfolio. I'll rank it for free. By the way, if you're uncomfortable with your current bank, whether you're Americans or Canadians, check out Battle Bank, a sanity bank, sanity
When does
based bank.
This is a question that came in. When do the doors open for Battle Bank?
That's up to the FDIC.
Okay.
we're we're ready to go.
Okay. All right. Fair enough. So we'll keep tabs on that. And then finally, you have a symposium coming up. We have to just mention that, right?
I do. I
When is
do.
it? What is it? Yes.
The Natural Resource Investment Symposium is approaching 30 years of age now, uh, which for an investment symposium is pretty old. I consider it to be the finest natural resources investment symposium in the world. Why? Several reasons. Great big picture thinkers, Daniela D. Martino Booth, Naomi Prince, Jim Rickards, people who tell you about the world the way it is, not the way that the CBC would prefer you to believe it to be. Then we have great analysts, people who've made money in natural resources for 3 decades, not guys who failed as auto analysts or retail analysts. We have the living legends, people who built multi-billion-dollar natural resource companies from scratch, telling you how the lessons they learned make them better investors and make you a better investor too. The upshot of all this is that at my conference, unlike any other conference, whether you attend in person July 7 through 11 in Boca Raton, Florida, or whether you attend via live stream in the comfort and convenience of your own home, if you don't feel that you've gotten your tuition's worth, in other words, if the information I give you isn't worth what you paid me for them, gold plated, 100%, no questions asked, money back guarantee. No other investment conference in the world that I know of has a money back guarantee. I've been offering money back guarantees on my educational products for 30 years. And I'm delighted to say that I've only had to refund less than 1/10 of the tuitions that I've charged. That notwithstanding, you compare my conference to any other investment product in the world, mine is the only one with a money back guarantee. And if you compare it with free conferences, understand if it's free, you're the product.
Okay, we'll keep that in mind. Check out the links down below to follow Rick, and don't forget to buy your tickets to the Rule Symposium coming up. So thank you very much, Rick, for that. We'll speak again soon.
David, thank you. I enjoy these. You work hard for your interviews, which I appreciate.
You make it easy for us interviewers. So thank you for doing this. Thank you for your service to the community, and we'll speak again soon. Thank you for watching. Don't forget to like and subscribe.